Welcome to the Global Energy Leaders Podcast, powered by R Squared Global.
Welcome to another edition of the Global Energy Leaders Podcast. As always, I'm your host, Ryan Ray. So good to have you. And today, we really go back to the books again as we bring on Alfonso Colombano, who's the author of Oil and Gas Company Analyses, Upstream, Midstream, and Downstream. And so we talk about the book, we talk about all kinds of stuff. Guys, I mentioned during the interview I hadn't finished the book, and I've been looking at it since the interview a little bit more. It's got a lot of good information there. So if you haven't checked that out, go and check out his book. A lot of good stuff. And so today we get into a lot of different stuff. We talk about, how do oil and gas companies view the market, how they make money, financial metrics, and all kinds of stuff that I thought was fascinating. And I hope you enjoy it too. Without further ado, here is my interview with Alfonso. Well, Alfonso, it's so good to have you today. How are you doing?
I'm doing great. Yeah, the weather here in Houston is a little bit cooler than a couple days before, so it's good.
Well, it's really windy. I'm up here just south of DFW. It's really windy up here today, so it's a little bit hotter than it has been, but it's been a decent breeze today, so not too bad. Well, let me kind of get into it here. How did you get into the oil and gas business? What was the interest to get into oil and gas in general?
Yeah, so that's a good question. So yeah, I'm very glad to be a guest in your podcast. So I started in the oil and gas industry about roughly 10 years ago. I lived in several countries. I lived in Venezuela for a couple of years. So that country has always been impacted by the oil and gas industry. So that got me a little bit of a head start as far as how commodity prices can influence an economy, how, for example, in Venezuela, you have very low gasoline prices, how that's impacted consumption over there. But I started reading more about, reports from the Energy Information Agency, the International Energy Agency, a couple books that I read, a couple podcasts as well. And that led me to move. I was born in Houston. I lived in a couple places, but I moved back to Houston. And then I went to the University of Houston, and I always said I want to work for an oil and gas company. So my first position was with ConocoPhillips, an integrated oil and gas company. And I worked in a couple other places, but basically the economy, the markets, how that impacted me to say, hey, I want to work in the oil and gas industry. And I started reading more and having being at the University of Houston being the world's energy capital. as a student, we had a lot of guest speakers come from different companies, so that increased my interest in the industry. So.
Okay, great. Well, let's talk about oil and gas. Obviously, when you think of oil and gas, you can think of a lot of different things. Some people, myself included, like to break it down into kind of the upstream, midstream, downstream sectors. Tell us about those terms and how are they, as far as business models go, how are they similar and how are they different?
Yeah, that's a great question. So, yeah, the oil and gas industry is key. And right before I started in the industry, I always thought that high oil prices were good for the entire industry. But that's not necessarily the case. And that's why it's important to understand how upstream, midstream, and downstream are impacted by the business model. So I will talk a little bit about upstream. So upstream is exploring, finding, and producing hydrocarbons. It's also known as exploration and production. But if you think about it, the upstream side of the business is more similar to what I would consider a mining business model, in the sense that the overall price level of whether you sell the commodity is critical. Your revenues are depending on that, your cash flows, etc. And so the higher the price, the absolute level, the more beneficial it will be for upstream. Midstream is a little bit different. So midstream consists of pipelines, terminals, natural gas gathering, processing, crude oil gathering, LNG facilities. And midstream is the sector in the oil and gas industry that in the medium and short term are less impacted by commodity prices. So their business model is more similar to, think about when you're traveling down a road and you have a toll road. The toll road has initial high capex, but the actual operating costs are relatively low, and the revenue stream are relatively fixed in the sense that you have a toll, and then your revenues depend on volumes flowing, so cars flowing through the system. So the midstream business model is similar to that. So you have a fee, where you charge as a fee for services for, let's say, transporting hydrocarbons, gathering hydrocarbons, processing hydrocarbons. They flow through your system, through your pipeline, through your gathering system, etc. And then you charge that fee, and then that's how your revenue stream comes in. So it's usually backed up or a sign up by long-term contracts. So your revenue stream is very, very consistent. You have a high initial capex. You have depreciation, you have those loans that a company has to pay back, but the revenues are very stable. Downstream, on the contrary, is more, I would say, downstream, which is refining of hydrocarbons, that is converting raw crude oil into refined products such as gasoline, diesel, jet fuel, and other products, as well as marketing, both wholesale and retail marketing, which is basically delivering or selling a refined product or other products to the end customers. For example, that is delivering a gallon of fuel to a local gas station. So downstream, their business model is more similar to what I would call a manufacturing business, typical manufacturing business. So downstream is highly impacted by not so much the absolute level of prices, but more around margins or the differentials between what you buy a raw commodity such as crude oil and other feedstocks when you can sell for the refined products for. So, and that's what they call the so-called crack spread, which is differential between where you can sell gasoline and diesel, one of the two main products of the refining process, minus what you buy the raw crude oil for. So the higher that spread, the better downstream it is. So it doesn't, the absolute level is not as significant. So gasoline prices could be low at the gas station, but downstream could be making a higher earnings because the crude oil is a lot lower.
Anytime we see a price fluctuation like we did a few years ago, or when the natural gas dropped, many years ago now, there's always a discussion of hedges. Who's got hedges, and how far out are they? How does that affect these different streams?
That's an excellent question. So I would say on the upstream side, traditionally since I would say many years ago, the so-called integrated oil and gas companies such as Chevron, ExxonMobil, Shell, they traditionally have not hedged because their natural hedge in a sense is their integrated portfolio. So they have midstream businesses and they have downstream. So if the price of oil is low, they might compensate it to some extent with the downstream margins going up. So on the hedging side, I would say the most impacted companies have been not even, I would say, if you think about the large independents, ConocoPhillips, Apache, some of them, they might do hedging at a smaller scale, but hedging is very, very critical in terms of the smaller E&P companies, particularly in the U.S. I know Pemex, it's a national company. They've done hedges in the past, but they've done it a couple times, and I think they've had it right. I think back in 2008. But overall, the smaller independent companies require a lot of the banking loans they have to be able to produce a reserve, but have requirements that basically have to hedge their production. So they can focus on, they may have hedges of, let's say they put them in place a couple of years and they have them at $70 a barrel. So that allows them to focus on production. How do I convert my reserves into production? So that's allowed them to, so as those hedges kind of expire, I would say around 2015, 2016, you saw a lot more credit concerns in the small E&P companies. So before they were doing relatively okay because even though prices might have been $50 a barrel, they were getting paid for crude for, let's say, $70 or $80 a barrel. So the hedges are critical now that a lot of them have expired, and you can basically hedge on the forward curves at a price that is around roughly what we have today, $45, $50 a barrel. You've seen a lot of companies restructuring in the small E&P companies, but also I think you've seen a lot of efficiencies as well as service costs and capex has come down. So companies like EOG, for example, come to mind. They've done relatively well at Contra Resources. A lot of them, in the sense that they've increased their efficiencies in terms of capex spending, so they can get they've high graded the portfolio in a sense, but also in a sense that, for example, if you had a portfolio where you're going to drill 100 wells, different quality scenario, you're only going to drill 20 wells, but those are going to be a lot better quality, a lot more higher initial production than you had a couple of years. Plus, the other benefit they're getting is around lower service costs.
Okay, so I just want to kind of recap what you said about hedging there to make sure that I was following along. One time I heard someone say that Walmart around Christmas time, what they'll do is they'll lower the cost of toys to break even or right above break even, because they know if you come into Walmart you and buy the toys, then you'll probably go buy groceries and pharmaceuticals and clothes and all this other stuff. And the local toy company, well, that's all they do is sell toys, so they can't really adjust their prices like Walmart can. And so it sounds like, if I'm understanding correctly, the bigger companies who have they have an upstream and a midstream and a downstream division, they can kind of internally figure out how to work through without hedging. Whereas the smaller companies, kind of like that local toy store, that's all they do. They don't really have the option. Is that a good way to kind of think about it?
Yeah, absolutely. Yeah, and also the additional pressure comes from the lending from banks that they basically want to be able to guarantee for a certain portion of their loans. They want to be able to have a steady cash flow coming in from producing hydrocarbons.
Okay, now you touched on money a couple times, and I want to kind of circle back around. One of the things that I remember very distinctly was when Chesapeake was kind of in free fall when the natural gas market plummeted. They got a line of credit. I don't remember the number off the top of my head, but it was a significant. It was in the hundreds of millions, and they were still having to cut work because that wasn't enough to run their daily business. Kind of walk us through how these companies look at their financial metrics, how they think about it, and maybe some misconceptions that the average person would not realize that these big oil and gas companies how they operate their finances.
Yeah, that is an excellent question. So yeah, so one of the things that the independent oil and gas companies in the U.S. have had, I would say, right before prices for oil started coming down around June 2014, is that first, and this I'm borrowing from a good friend of mine, Rusty Brazil's Domino Effect, highly recommended book. So before, when natural gas prices started coming down, what a lot of companies could do is basically switch over from natural gas drilling to natural gas liquids. Focus on plays that have higher liquids content. So that was part of their portfolio there. But the problem was that even though natural gas prices are low, you still have to produce natural gas, right? When you drill for NGLs, they're associated with the gas, so you have to produce both. So natural gas was seen more of a byproduct in the sense that you were drilling for natural gas for liquids rich plays, so producing natural gas more as a byproduct. So production, even though prices were down, production's up, which defines supply demand 101, right? Prices are low, you would see supply go down. But what happened is that these hydrocarbons are always interrelated. So then natural gas liquids around 2012, 2013 started really coming down. So companies shifted their focus from liquids rich gas wells to oil wells and producing everything else as a byproduct. So now NGL's prices were low. People thought, oh, prices are low, supply's going to come down. No, it actually increased because it was the same concept with natural gas. Natural gas liquids and natural gas were seen as a byproduct of oil. You were drilling for the oil. If you produce natural gas and natural gas liquids, you get some kind of net price, net back. That was nice, but you were drilling for the oil. But what's happening after 2014 is that prices really for oil, started coming down. So, where's the other commodity? There's no other commodity to run to. So what's happening is that companies that really have to focus on high grading their portfolio internally, looking at metrics. For example, one of the key metrics, small E&P and independent E&P, is initial production. So in the shale wells, one of the key metrics has been initial production, so or IP rates. So when you're in the shale wells, decline rates are significantly higher than conventional wells, and that has both a benefit and a downside, right? The downside is that you continuously have to increase capex, every year to be able to sustain production. Before you could, put a couple of wells, they naturally decline, let them decline, but now, what companies have focused on with IP initial production rates is that where are the wells that can deliver the highest production rates initially, so we can get our cash flow the quicker. For example, Chevron's a good example. Before, their portfolio consisted of still consists of large LNG facilities, high and then very expensive projects. Now they're focusing a lot on the Permian. Why? Because they can increase capex and get their cash back really quick. The pay rates are on some of these plays, especially in the Permian, a year to 18 months. So what's happened is that they've needed to focus on high initial rates of production. The other metric that a lot of companies are focusing on than before when prices were high is around working capital. Working capital is key, especially in the downstream side of the business. So let me explain a little bit about working capital. So working capital particular for downstream tends to collect sales of fuels and gasoline on a very short-term basis. We're talking 5 to 10 days in the U.S., but payments for crude oil are around 30-day terms. Yeah, in the downstream side, payment terms are around 7 to 10 days for collection of fuels and sales. But on the payment side, it's 30. So naturally, downstream always has a positive working capital because you collect faster, you pay slower. Upstream, on the other hand, they're on the other side of the coin, right? They collect the 30-day terms. So working capital fluctuations, which before in the industry nobody paid attention because companies were flooded with cash, now are a lot more critical. So payment terms. The other thing is the creditworthiness of your customers. For example, midstream companies, a lot of midstream companies have had to that, even though they were seen before, before lower prices is very safe. A lot of the emphasis has been on the credit quality of the customers. So if you're a natural gas gathering company and you have a lot of your customers are going under, how are they going to pay you? So a lot of companies have focused on, we do only business with, triple B credit rating or certain credit rating, above investment grade, so that their investors are a lot more comfortable. The revenues are going to be consistent and they can depend on those cash flows in the future.
Okay, you mentioned credit rating there. Just out of curiosity, I know over the last 2 years you've seen a lot of doom and gloom news. Has that really affected the market? Have there been a lot of companies who have had their credit rating downgraded, or have they been able to survive the storm for the most part?
Yeah, I mean, it certainly has impacted, a lot of companies. For example, even ExxonMobil, I can't remember the credit rating company, but one of their credit rating companies downgraded them from their AAA. Not even the U.S. government has, before they had a AAA rating. So there's a couple companies that have been downgraded, Chevron, for example. But a lot of the credit rating downgrades has happened in the smaller E&P companies that have been downgraded. A lot of them have gone into restructuring. But I would say it really has not impacted as much overall. Production has come down to some extent. But the interesting thing is that for example, if a company's restructure, those assets, those wells are still in place. So another company could come in, finance it, and lower cost operator can come in and buy those assets. For example, we've seen at ConocoPhillips, they've sold some of their Canadian properties. They're planning to sell some of their Canadian properties and properties in the San Juan Basin in New Mexico. So companies that are lower cost, lower overhead can come in and operate those assets more efficiently. So I think the focus has been relentless efficiency. How can we improve costs, do it at a faster rate? And you've seen even some companies, large integrated oil companies, partner up with some of these smaller companies that nobody knew a couple of years ago because they're a lot more efficient. They have a less of structure in their business, how they operate their business, so they can complete it well a lot faster than say an ExxonMobil or a Chevron.
Yeah. Now, one of the things I've noticed, I mean, it's not like I've noticed it alone here. There's been a lot of talk about M&A activity, especially in the Permian Basin, and you're seeing a lot of these bigger companies, the majors, IOCs, whatever you want to call them, that are coming in and buying up assets. It seems like every week there's a new deal going on out there. Is that because what we're going to see the next 3 to 5 years is more of a integrated approach to oil and gas, where the bigger companies, kind of like the Walmart model, they're gonna be able to come in and walk through the process from A to Z, or is that just kind of a short-term push? And maybe I'm reading too much into that.
No, that's a great question. I would say, the longer-term approach, I think, is still applicable, especially in the Permian Basin. The Permian Basin has been a very resilient asset for all the companies that are there. One of the key advantages that it's had, and I think long-term, is access to the Gulf Coast, the Houston Gulf Coast area, which gives you access to the largest refinery complex in the world, which is the U.S. Gulf Coast. So I think the Permian Basin is a key play for a lot of companies that are seeing that growth. The other thing that benefits the Permian Basin, and specific to several companies, that a lot of companies have had very old leases from the 1920s, even from the late 19th century, and a lot of those leases are low royalty or no royalty. So a lot of companies have been able to keep those leases and invest more because they are able to hold when you have an oil and gas lease, usually you have a certain term that you have to start drilling and producing. But if you have a lease that doesn't have those clauses, then you can hold longer your portfolio. So a lot of the companies have bought it because they have those flexible terms. While contrary, for example, the Eagle Ford, a lot of the leases were relatively fairly new, and they had clauses around having to produce hydrocarbons within a certain time frame after you sign the lease. Kind of produce it or lose it type of thing.
Okay, one final thing before I want to talk about your book for just a second, but before we get to that, MLPs, it seems to be kind of like the buzzword of the day. Kind of break down why are they so popular right now?
Yeah, so the MLPs are master limited partnership. They've been around for quite some time now. I believe the first one was Apache. EMP, MLP back in the early 80s. They discontinued that business form, but really for the U.S. the key advantage around the MLP is that they're considered a pass-through entity. So the fact that companies avoid having double taxation. So in a regular C corp, you're taxed both at the corporate level and when you distribute dividends, which in the U.S. the maximum rate is about 20% for dividends, and the corporate rate is about 35 plus the state income taxes. So the MLPs are pass-through entities that avoid taxation at the entity level. So an owner of an MLP, or what they call a unit holder, at the end of the year would get a K-1 schedule, which basically has a pro rata share of revenues, expenses, and earnings, and then unit holders are able to file their taxes with that. The key reason MLPs are so popular is that they're able to access the credit markets. They have a lower cost of capital just by the nature of being tax advantage entity. For example, the cost of capital for a regular C corp might be 5%, and MLP might be 3.8%. So the differential in the cost of capital gives them an advantage from the head start. The other thing about MLPs that makes them so popular is that their cash flows are a lot more stable than, say, downstream company or upstream company. The fact that every contract, the contracts around MLPs have to structure around how do I guarantee, everything is about how do I increase the distribution every quarter. So how do I grow cash? How do I grow cash distributions? And also the fact that the revenue streams are very stable. There's only a couple that I can think about MLPs that are not midstream. I think there's 2 or 3 in the refining space and a couple in the upstream space, and they have to stabilize their cash flows through hedges and other mechanisms. But the MLPs are very stable because they grow their distributions. And for example, Enterprise Products Partners, they've grown their distribution since their IPO in 1998. They're very able to focus on how do I acquire assets to grow distributable cash flow. The other thing they're able to do is because of their financial structure, they're able to take on a lot more debt than a regular C corp because again, their cash flows are stable. They have 5, 10, 20-year contracts with producers and downstream companies to be able to transport or export products out of their assets. So they're very sought after because of their stability of the cash flows and the ability to some extent, especially on depending on the type of asset, if it's more of a, for example, a gathering line, gathering pipeline, those assets are a little bit more sensitive to an extent to crude oil prices. But if it's for example an NGL or a propane export terminal, those are less sensitive because right before they start construction, they have shippers or producers or users of the terminal sign up for long-term contracts with deficiency agreements. So these companies are going to get a payment whether customers flow molecules through their system or whether they don't.
Okay, well, that was very helpful there. Let's talk about the book for a second. I'm actually holding a copy of it right now. Oil and Gas Company Analysis, Upstream, Midstream, and Downstream. What led you to write the book?
Yeah, so that's a great question. So I've always enjoyed reading companies' publications, whether there be SEC forms, 10Ks, or 20Fs, or annual reports. So something I've always had a passion to analyze companies, compare companies. And I decided, back in 2014 to, let me go ahead and put this in writing and start writing a book. So I designed a model in Excel to compare all the different companies. I use a lot of the, publicly available information, external publications, for U.S. companies as well as one of the challenges around some of the NOCs. They don't, report as much information as regular, U.S. publicly traded companies. So that was a bit of a challenge, but it was a fun challenge. The other thing is that I learned about different companies in different countries. I analyzed 2 companies from Russia, 1 company from China, 1 company from France. So different types of countries and how they approach production, oil and gas activities.
Awesome. Well, as I'm flipping through it here, I have not read it yet. I do have a copy of it though. It's on my. If you're like me, you say you love to read, you get a stack of books that you're trying to work through. So it's in my stack and it hadn't been read. But looking through it, there is a lot of analysis here. How long did it take you to kind of compile all that research? Because there's a lot of companies that it looks like you cover and a lot of analysis here.
Yeah, so that's a good question. So I started writing the book around April, May of 2014. Then I completed it by January 2015. So it was a very intensive process. It took me about, I was counting the hours, it took me about 700 to 900 hours to complete. But it was a process that very enjoyable process, very fun process to learn about all these different type of companies and how they're similar, how they're different, and how to come up with metrics that you're able to compare some of the companies and see this company is performing better on this metric or this metric, or how do you standardize those metrics to say net income for these purposes is this, or return on capital employed is this. So it involved a lot of heavy calculations and manual extractions of public sources of data.
I can imagine. Well, look, thank you so much for coming on. Is there anything else that you would like to plug or promote before we let you get out of here today?
Yeah, absolutely. Yeah. So I'd like to promote my book. My website is www.oilgascompanyanalysis.com, or you can Google my name, Alfonso Colombano, Alfonso. Last name is Colombano. And I actually have two books. I have one, the first version that I published 2 years ago is Oil and Gas Company Analysis. It's in English. I have another version, since I speak also Spanish as well. I have a shorter version in Spanish if people are interested in learning about oil and gas terminology in Spanish. That's a great book. And I'm actually, right before the end of the year, I'm coming up with a third book. I'm in the process of writing a third book around. It takes a deep dive into global refining and marketing business. So it'll be titled Oil and Gas Company Analysis, Global Refining and Marketing, taking a much more deeper dive into refining, marketing, and trading processes within the oil and gas industry.
Well, great. We'll be watching for that. And when that comes out, we'd love to have you on to discuss that in a little bit more depth. So thanks again for coming on. We look forward to talking to you in the future.
Yeah, but I'm delighted. This is a great opportunity. I'm very thankful for the opportunity to be interviewed on your podcast. So thank you very much.
Thank you. Have a good day.
You too. Thank you very much.
Thanks again for Alfonso coming on. You can find all of his information in the show notes at globalenergymedia.com, where we have show notes page for all of our podcasts. And also, I believe Alfonso, as he mentioned, he has a book coming out at the end of the year, so we'll have him back on then. And we're also looking to bring him on here in a few months, and we're working on an idea that's kind of neat, I think. And we're going to say, okay, Alfonso, you specialize in going in and reading these forms and breaking this down. So someone like myself who works for an engineering firm, we're always trying to find out, how do you find clients? And if you find a company, if you're like me, you'll find a company you've never heard of before, and you go, okay, is this a viable option? How would you go about looking at a company just from a standpoint of dissecting their information and what's in the stock market reports and all these different sources that he uses and bringing them in and kind of give you an idea of, okay, do they have money? Do they have cash on hand? Will they be able to, keep going at the current pace? So we're working on that, and we'll keep you updated. Hopefully we'll do that here in a few months and get that pulled off. Thank you so much for tuning in, and until next time, keep climbing.
Thanks for listening to the Global Energy Leaders Podcast, powered by R Squared Global.